Chapter 21: The Influence of Monetary and Fiscal Policy on Aggregate Demand. In this chapter, we answer the following questions. How does the interest rate help explain the slope of the aggregate demand curve? How can the central bank use monetary policy to shift the aggregate demand curve? In what two ways does fiscal policy affect aggregate demand? What are the arguments for and against using policy to stabilize the economy? Monetary and fiscal policy. Monetary policy is the supply of money set by the central bank. In fiscal policy, the levels of government spending and taxation set by the President and Congress. Aggregate demand. Recall that the aggregate demand curve slopes downwards for three reasons: the wealth effect, the interest rate effect, the exchange rate effect. Next, a supply-demand model that helps explain the interest rate effect and how monetary policy affects aggregate demand. However, the most important of these effects for the U.S. economy is the interest rate effect. Theory of liquidity preference 1. The theory of liquidity preference is Keynes' theory that the interest rate R adjusts to bring money supply and money demand into balance. Nominal interest rate and real interest rate. The assumption is expected rate of inflation is constant. Money supply, or MS, is assumed fixed by central bank and does not depend on interest rate. Money demand, MD. Money demand reflects how much wealth people want to hold in liquid form. Assume household wealth includes only two assets: money, liquid but pays no interest; bonds, pays interest but not as liquid. A household's money demand reflects its preference for liquidity. How R is determined. Money supply curve, or MS curve, is vertical. Changes in R do not affect money supply, which is fixed by the Fed. Money demand curve is downward sloping. A fall in R increases the quantity of money demanded. Equilibrium interest rate is where money demand and money supply cross. Variables that influence money demand: Y, R, and P. Suppose real income, or Y, rises. Households want to buy more goods and services, so they need more money. To get this money, they attempt to sell some of their bonds. An increase in Y causes an increase in money demand, other things equal. Active Learning 1. Determinants of money demand. What happens to money demand in the following two scenarios? A. Suppose R rises, but Y and P are unchanged. B. Suppose P rises, but Y and R are unchanged. Answers. A. Suppose R rises, but Y and P are unchanged. R is the opportunity cost of holding money. An increase in R reduces the quantity of money demanded. Households attempt to buy bonds and take advantage of the higher interest rates. Hence, An increase in R causes a decrease in the quantity of money demanded, other things equal. B. Suppose P rises, but Y and R are unchanged. If Y is unchanged, people will want to buy same amount of goods and services. Since P is higher, they will need more money to do so. Hence, an increase in P causes an increase in money demand, other things equal. How the interest rate effect works. The interest rate is money market and aggregate demand. A fall in price from P1 to P2 reduces demand, which lowers R. Money demand shifts to the left. Interest rate declined from R1 to R2. A fall in R increases I, investment, and the quantity of goods and services demanded, which is Y. So Y moves from Y1 to Y2. Monetary policy and the aggregate demand. The Fed uses monetary policy to shift the aggregate demand curve. Policy instrument, the money supply MS, targets the interest rate, the federal funds rate. Banks charge each other on short-term loans. That is the federal funds rate. That is the rate at which banks borrow from each other. And the Fed conducts open market operations to change money supply. Effect on reducing money supply. A Fed can raise R by reducing money supply, shifting from MS1 to MS2, which raises interest from R1 to R2. An increase in R reduces the quantity of goods and services demanded in the second draft from Y1 to Y2. The role of interest rate targets. Because the MS is hard to measure with sufficient precision and MD fluctuates over time, leads to fluctuations in interest rates, aggregate demand output. Fed policy set a target for federal funds rate, accommodates the day-to-day shifts in money demand by adjusting the money supply accordingly. Monetary policy can be described either in terms of money supply or in terms of the interest rate. Active Learning 2 Monetary Policy. For each of the following of the events below, determine the short-run effects on output, determine how the Fed should adjust the money supply and interest rates to stabilize output. A. Congress tries to balance the budget by cutting government spending. B. A stock market boom increases household wealth. C. War breaks out in the Middle East, causing oil prices to soar. Answer A. Congress tries to balance the budget by cutting government spending. This event would reduce aggregate demand and output. To stabilize output, the Fed should increase money supply and reduce interest to increase aggregate demand. B. A stock market boom increases household wealth. This event would increase aggregate demand, raising output above its natural rate. To stabilize output, the Fed should reduce money supply and increase interest to reduce aggregate demand. C. War breaks out in the Middle East, causing oil prices to soar. This event would reduce aggregate demand, causing output to fall. To stabilize output, the Fed should increase money supply and reduce interest rate to increase aggregate demand. The zero lower bound liquidity trap. If interest rates have already fallen to around zero, monetary policy may no longer be effective since nominal interest rates cannot be reduced further. Aggregate demand, production, and employment may be trapped at low levels. A central bank continues to have tools to expand the economy. Forward guidance raise inflation expectations by committing to keep interest rate low. Quantitative easing buy a larger variety of financial instruments, mortgages, corporate debt, and longer-term government bonds. This was introduced by the Fed in 2008. How fiscal policy influences aggregate demand. Fiscal policy is setting the level of government purchases, G, and taxation, T, by government policymakers. An increase in G and or decrease in T shifts aggregate demand to the right. A decrease in G and or an increase in T shifts aggregate demand to the left. The multiplier effect. Assume the government buys $2 billion worth of military trucks from Oshkosh Corporation. What is the effect of this purchase on the aggregate demand? Because G increases by 2 billion, the aggregate demand shifts to the right by 2 billion. Oshkosh revenue increases by 2 billion, distributed to Oshkosh workers as wages and owners as profits or stock dividends. These people are also consumers and will spend a portion of the extra income. C increases, and so aggregate demand increases. The multiplier effect diagram. A 2 billion increase in government spending, G, initially shifts aggregate demand to the right by $2 billion. Shifts from AD1 to AD2, and output increases from Y1 to Y2. The increase in Y causes C to rise, which shifts aggregate demand curve to the right. And aggregate demand curve shifts to AD3 and output shifts further to Y3. Multiplier effect, the additional shifts in aggregate demand that results when fiscal policy increases income and thereby increases consumer spending. Marginal propensity to consume. How big is the multiplier effect? This depends on how much consumers respond to increase in income. Marginal propensity to consume, or MPC, is delta C over delta Y, the fraction of extra income that households consume rather than save. For example, if MPC is 0.8 and income rises 100, C will rise by 80. A formula for the spending multiplier. Notation: delta G is the change in government. Delta Y and delta C are the ultimate changes in output and consumption. So Y is equal to C plus I plus G plus NX is an identity. So delta Y is equal to delta C plus delta G. I and NX do not change. delta y is equal to MPC times delta y plus delta g, because delta c is equal to MPC times delta y. We solve it for y, for delta y, so delta y is equal to 1 over 1 minus MPC times delta g. And this is the multiplier. The formula for the multiplier is 1 over 1 minus MPC. Example 3. Calculating the spending multiplier. Calculate the spending multiplier when MPC is 0.5, 0.75, and 0.9. What is the relationship between the MPC and the simple multiplier? If MPC is 0.5, the multiplier is 1 over 1 minus MPC, which is equal to 2. If MPC is 0.75, the multiplier is equal to 4. If MPC is equal to 0.9, the multiplier is equal to 10. We can observe here that the bigger the MPC, the bigger the multiplier. A bigger MPC means changes in output causes bigger changes in consumer spending, which in turn causes bigger changes in output. Other applications of the multiplier effect. The multiplier effect, each dollar increase in government can generate more than $1 increase in aggregate demand. Also true for other components of GDP like C and I and G and NX. Example 4, how big of a change in aggregate demand? Suppose a recession overseas reduces the demand for U.S. net exports by $10 billion. What is the initial change in aggregate demand? If MPC is equal to 0.8, what is the change in output? Initially, AD falls by 10 billion. The spending multiplier is 5. The decrease in Y is 5 times $10 billion, which is equal to $50 billion. The crowding out effect. The crowding out effect, offset in aggregate demand, results when expansionary fiscal policy raises the interest rate, thereby reduces investment spending, which reduces the net increase in aggregate demand. So the size of the aggregate demand shift may be smaller than the initial fiscal expansion. Example 5, the crowding out effect. Assume the government buys $2 billion of military trucks from Oshkosh Corporation. This will shift aggregate demand curve from AD1 to AD2 by 2 billion, increasing output from Y1 to Y2. But higher output increases money demand and interest rate, which reduces aggregate demand. Interest rate goes up and aggregate shifts back to AD3. Changes in taxes. A tax cut, an increase in households' take-home pay. That is what a tax cut is. Households respond by spending a portion of this extra income, shifting aggregate demand to the right. The size of the shift is affected by the multiplier and crowding out effect. Another factor, household perception. Permanent tax cut leads to larger impact on aggregate demand. Temporary tax cut leads to smaller impact on aggregate demand. Active learning 3, fiscal policy effects. The economy is in recession. Policymakers think that shifting the aggregate demand curve rightward by 200 billion would end the recession. Number A, if MPC is equal to zero point 0.8 and there is no crowding out, how much would Congress increase G to end the recession? Number B, if there is crowding out, will Congress need to increase G by more or less than this amount? Answer A. Shifting the aggregate demand curve rightward by $200 billion would end the recession. Number A. If MPC is 0.8 and there is no crowding out, how much should Congress increase G to end the recession? The multiplier, which is 1 over 1 minus 0.8, which is equal to 5. Increase in government by $40 billion to shift the aggregate demand by 5 times 40, which is $200. And yes, that will end the recession. B, shifting the aggregate demand curve rightward by 200 would end the recession. Number B, if there is crowding out, will Congress need to increase G more or less than this amount? Crowding out reduces the impact of G on AD. To offset this, Congress should increase G by a larger amount. Fiscal policy and aggregate supply curve and aggregate supply. Fiscal policy might affect aggregate supply. People respond to incentives. You know that. A cut in the tax rate gives workers incentive to work more, so it might increase the quantity of goods and services supplied and shift aggregate supply to the right. People who believe this effect is large are called supply-siders. G might affect aggregate supply. Example, government increases spending on roads. Better roads may increase business productivity, which increases the quantity of goods and services supplied, which shifts aggregate supply to the right. This effect is probably more relevant in the long run. It takes time to build the new roads and put them into use. The case for active stabilization policy. Keynes states that animal spirits cause waves of pessimism and optimism among households and farms, leading to shifts in aggregate demand and fluctuations in output and employment. Also, other factors cause fluctuations: booms and recessions abroad, stock market booms and crashes. If policymakers do nothing, these fluctuations are destabilizing to businesses, workers, consumers. Proponents of active stabilization policy states that government should use policy to reduce these fluctuations. When GDP falls below its natural rate, use expansionary monetary or fiscal policy to prevent or reduce a recession. When GDP rises above its natural rate, use contractionary fiscal policy to prevent or reduce an inflationary boom. Keynes in the White House, case study. In 1961, John F. Kennedy pushed for a tax cut to stimulate aggregate demand. Several of his economic advisors were followers of Keynes. In 2009, President Barack Obama, economy was in recession. Policy stimulus bill, they called the American Recovery and Reinvestment Act, ARA, substantial increase in government spending. Ask the experts, economic stimulus. Because of American Recovery and Reinvestment Act of 2009, ARRA, the US unemployment rate was lower at the end of 2010 than it would have been without the stimulus bill. 97% agree, 3% disagree. Economic stimulus, taking into account all of the RR's economic consequences, including the economic cost of raising taxes to pay for the spending, its effects on future spending, and any other likely future effects, the benefits of the stimulus will end up exceeding its costs. 75% agree, 19% are uncertain, 6% disagree. Case against stabilization policy. Monetary policy affects economy with a long lag. Firms make investment plans in advance, so investment takes time to respond to changes in interest rate. Most economists believe it takes at least 6 months for monetary policy to affect output and unemployment. Fiscal policy also works with a long lag. Changes in government and tax requires acts of Congress. Legislative process can take months or even years. Due to these lags, critics of active policy argue that such policies may destabilize the economy rather than help it. By the time the policies affect aggregate demand, the economy's condition may have changed. Content contend that Critics contend that policymakers should focus on long-run goals like economic growth and low inflation. Using policy for stabilization. Automatic stabilizers. Automatic stabilizers are changes in fiscal policy that stimulate aggregate demand when the economy goes into recession. Automatic stabilizers occur without policymakers having to take any deliberate action. Examples of automatic stabilizers. The tax system. In a recession, taxes fall automatically, which stimulates aggregate demand. Government spending. In recession, more people apply for public assistance, welfare, unemployment insurance. Government spending on these programs automatically raises, which stimulates aggregate demand. Think, pair, and share. The news reports that the Fed raised interest rate by 0.25% today to head off future inflation. The report then moves to interviews with the prominent politicians. The response of a member of Congress to the Fed's move is negative, she says. The consumer price index has not increased, yet the Fed is restricting growth in the economy, supposedly to fight inflation. My constituents will want to know why they are going to have to pay more when they get a loan, and I don't have a good answer. I think this is an outrage, and I think Congress should have hearings on the Fed's policymaking powers. A. What interest rate did the Fed raise? B. State the Fed's policy in terms of the money supply. C. Why might the Fed raise interest rates before the CPI starts to rise? D. Many economists believe that the Fed needs to be independent of politics. Use the Congresswoman's statement to explain why so many economists argue for Fed's independence. Chapter in a nutshell. Theory of short-run economic fluctuations. Keynes' theory of liquidity preference to explain the determinants of the interest rate. Interest rate adjusts to balance supply and demand for money. An increase in the price level raises money demand and increases the interest rate that brings the money market into equilibrium. A higher interest rate reduces investment spending and thereby reduces the quantity of goods and services demanded. The downward sloping aggregate demand curve expresses this negative relationship between the price level and the quantity demanded. Monetary policy is increasing money supply, reduces the equilibrium interest rate for any given price level, stimulates investment spending, the aggregate demand curve shifts to the right. Fiscal policy, increasing government purchases or a cut in taxes, shifts the aggregate demand curve to the right. When the government alters spending or taxes, the resulting shift in aggregate demand can be larger or smaller than the fiscal change. The multiplier effect amplifies the effects of fiscal policy. The crowding out effect dampens the effects of fiscal policy. Advocates of active stabilization policy, changes in attitudes by households and farms shift aggregate demand. If the government does not respond, the result is undesirable and unnecessary fluctuations in output and employment. Critics of active stabilization policy. Due to long lags, attempts at stabilizing the economy often end up being destabilizing.